If you were scammed $1 million tomorrow, would your bank give your money back? Most people have no idea what the law actually says. More than 1 in 3 adults in the United States have experienced a scam or financial fraud in the past year. Worldwide, an estimated 608 million people fall victim to scams every year, and scammers stole over $1 trillion globally last year. With numbers this huge, many people wonder, are banks required to refund scam victims? You might think that if banks had to refund every victim, many banks would go bankrupt. But the truth is, the answer is not as clear-cut as it should be. In this video, we'll break down what obligations banks owe their customers, why the law changed recently, when banks must reimburse victims, when they can refuse, and what you should do if you've been scammed. Let's start with the basics. Banks generally owe their customers a duty of care. This means they must exercise reasonable care and skill when carrying out banking functions. One part of this duty is known as the care duty. It comes from a 1992 case in the High Court of England and Wales, Barclays Bank versus care. For years, some people believed this duty required banks to stop suspicious transactions, even if the customer instructed the bank to make the payment. But in 2023, everything changed. The UK Supreme Court made a major ruling in Philip versus Barclays Bank. This decision restricted the care duty. The court clarified that banks are not required to refund customers who personally authorize a payment to a scammer. Why? Because the care duty only applies when instructions come from an agent acting on behalf of the customer, not the customer themselves. So if a customer directly instructs their bank to make a payment, even if they are being manipulated, the bank must follow that instruction immediately. This type of scam is known as authorized push payment fraud, or APP fraud. And the Supreme Court confirmed that the care duty does not apply to APP fraud. After the Philip ruling, the UK government introduced in 2024 a new mandatory reimbursement scheme under the Financial Services and Markets Act. This scheme requires banks to reimburse victims of APP fraud, usually up to a specific limit. Originally, the proposed cap was £415,000, but the payment systems regulator decided on a maximum reimbursement cap of £85,000 per claim. This amount is designed to cover over 99% of cases. Higher awards can still be recommended in exceptional situations. Banks must reimburse victims within 5 business days. In some cases, investigations can extend this to 35 business days. However, reimbursement is not automatic. Banks can generally refuse to reimburse a customer if the customer was grossly negligent. Gross negligence means a very significant degree of carelessness or ignoring an obvious risk. Key factors include ignoring warnings. If the bank or police gave clear, specific warnings about a scam and the customer ignored them. Failure to report promptly. If the customer did not report the fraud quickly after realizing something was wrong. Lack of cooperation. If the customer refused to provide reasonable information needed for the investigation. If any of these factors apply, the bank may legally refuse reimbursement. Even with the new scheme, banks should certainly be made to bear more responsibility. Why? The first reason is preventable failures. In many scams, the receiving bank identifies a mule account but does not freeze it quickly enough. A mule account is a bank account used by scammers to receive and move stolen money, often through someone who lets their account be used, knowingly or unknowingly. Another reason is systemic responsibility. Banks profit from fast digital payments. Banks should therefore invest more in AI-driven fraud detection instead of placing the burden on consumers. The last reason is increasingly sophisticated scams. Modern scams use psychological manipulation that even smart, educated people fall for. Banks should surely be acting as a stronger safeguard. And here's the reality. In most countries, banks reimburse only 2% to 4% of scam losses. So it's no surprise that pressure is growing for banks to take on more liability. While the law continues to evolve, here's what you should do right now if you or someone you know becomes a scam victim. Immediately contact your bank and request a refund in writing. If the bank refuses, challenge the decision through the bank's internal complaints process. If the bank still refuses, escalate the matter to your local authority. For example, in the UK, you can file a complaint with the Financial Ombudsman Service. Acting quickly increases your chances of recovery. Scams are becoming more sophisticated every year. And while the law is slowly shifting toward greater consumer protection, the rules are still far from perfect. Understanding your rights and knowing how banks handle scam cases is essential. If you found this video helpful, consider subscribing for more clear, practical explanations of real-world legal issues.